Greetings to all. Welcome to our new episode. Today we will talk about investment, particularly mutual fund.
Yeah, so we have been hearing about the stock market rising for the last few weeks, and this has tempted or it tempts people to enter the market and invest in stocks directly. This is good, but the beginners have to be a bit more cautious in investing directly in the stock market. The main reason being the timing of the entry, timing of investment. So now the question would be, what is the correct timing for investment? So there are different views about it. Some argue that there is no right time to invest in the market. Um, they argue that see people buy stocks when it is low and sell when it is high to make profit, but the seasoned investors do short selling, meaning they sell first and then buy at a lower rate to make profit. So there is no right time for a seasoned investor, but this is not always true about the beginners. For beginners, the popular theory suggests investing in markets when the market is up, or market is down, or the shares prices are low, so that they can make profit. When the market goes up. The question now is, then what is the best option for the beginners? Of course, it is mutual fund. Then can we let us see what exactly is mutual fund? A mutual fund is this. A mutual fund company sells mutual fund units to many investors and pools the money, and the pooled money will be invested in multiple assets like shares of the company, the bonds, government securities, and other assets in the market, and they make profit out of it. The profit can come in the form of income, like dividend on shares, interest on bonds, and gains comes in the form of appreciation in the value, meaning you buy something asset, for example, a share for 100 rupees, and then the market goes up and it reaches say 150, there is an appreciation of 50 rupees on that investment. That's the appreciation. So this income, in the form of the gains in the form of income and appreciation are distributed in the proportion of the units held by the investors. So that is how the mutual fund operates. Now there will be a question: is the mutual fund the right option or the investment option for beginners? See, mutual fund is an ideal investment, not only for beginners, it is for any type of investors, including seasoned investors. They invest a lot in mutual fund. But the advantage for the beginners come from these two factors. The seasoned investors invest not only in mutual fund, they invest in shares and other securities and other assets too. But beginners don't have the understanding or the knowledge or the expertise of the market, and they don't have the time or aptitude to research on the market so that they can take the right decision when to buy which share in what, and when to exit, when to sell the shares and make profit, or decrease the loss or whatever. So now, how do they do that? See, mutual fund is the option because mutual fund invest in markets, but the real investor doesn't do that directly. So they buy the units, and the pooled money is invested by the mutual fund company, and professional mutual fund managers does the decision of investment. Where to invest, which shares, which proportion, which shares or assets to invest in, and when to exit those investment, in what proportion the investment has to be made, and so on. So the real retail investors, meaning the common the beginners, don't have to worry about that. So whatever the profit they make would be distributed among the mutual fund holders in the proportion of their holding, less whatever the charges the mutual fund company charges the investors for their services. Now, another factor which we'll have to look at is, see, if you are a beginner and you have some money to invest in, traditionally people make invest in fixed deposits, or some which is actually gives you very low return but safe, and gold sometimes, which is not. It's good for to an extent, but beyond that, it may not give you better returns. And then real estate, of course, if you do it judiciously, it will give you profit, but you have to be careful. And at the same time, the liquidity can be a problem, because it may not be possible to liquidate or convert that into cash as you want. That's the problem. So what's the best option? The mutual fund. So that's we said, then we let. So but the professional managers makes the decision on your behalf and all, but you need to take a decision on which mutual fund you are to invest in. See, that comes on from different aspects. For example, there are different variants of mutual funds. Let's look at in two broader categories. One is a growth fund, meaning investment which will bring higher growth but at a higher risk. So those kind of mutual funds invest 100% or majority of their pooled money in shares. So the shares can go up and can grow like anything, and but there is risk too. Some people would opt for balanced funds, meaning those kind of funds will invest partially in shares which are high growth but high risk, and but a portion of that will be invested in bonds and other fixed income earning assets. So it is safe. There won't be much of a fluctuation in those the value of the assets, but the return will also be comparatively low. So it all depends on your aptitude. So you have to decide actually what kind of mutual fund you want to invest, based on your appetite. You want higher return or moderate return or low return, or you are ready to take higher risk or moderate risk or low risk, and so on. So this is a vast subject. We need to come out with few more videos on investing as well as mutual fund, because there are a lot of many different types of investment, many different variants of mutual funds, and then the decisions on timing of the investment, where to invest, in what proportion you have to make portfolio, and what are the pros and cons of different types of investments and all. So we'll come back with few more videos. Till then, bye. Take care. Thank you.